right, our first podcast from our new office. I've been put down in the basement with no windows. Clark retained
They
the
didn't
lead
give you a
business.
window, Jay, like they gave me.
Uh-uh.
And
No.
let's correct you. You're not actually in a basement. It does look like you're in a closet in a basement, but you are just next door to me. I don't know how I got this and you got that, but
And you probably got your armoire of all your clothing being behind you there. Looks good though.
Oh, nice. Very comfortable.
painting you have as a backdrop there, Craig, of the skyline of downtown Kelowna looks great. It looks sunny today.
Well, I'm telling you, the weather here has been pretty erratic. I don't know where we're at. I don't know if we're into late winter, early spring, but we'll see. Golf courses are opening, ski hills open. It's that time of year.
Talk about erratic. We've got a crazy world these days. I think we were going to talk about a few of these things today.
Yeah.
Get right into it. We're recording this March 10th, and obviously the big news, the ongoing conflict in Iran that's running into its 10th or 11th day. I think it's worth noting, obviously, with anything where bombs are falling. We are going to look at this as unemotionally as possible from a market perspective, and hopefully provide some guidance for clients in terms of how to look at things. So, what's been the market response, Craig, as we're in day 10 of the current conflict?
Yeah, well, that's probably the question that most of our clients are faced with these days, and I think that's what markets are trying to determine. I would say the quick answer is markets have been quite resilient over the last week for sure. It certainly feels like a headline-driven market. And when I say headlines, in my perspective, I think it's really tied to what's happening with the price of oil these days. Look no further than a few days ago, coming into Sunday morning. I think Clark, you were texting me saying that oil prices were up 25% and were upwards of $120 a barrel. Here we are 3 days later, we're back down to 85, 86. Not saying we're still not elevated from where we were February 27th, but at the end of the day, it really is a fast moving market environment right now, driven by typical tweets from the Trump administration, calls that they're near the end of the war, and again, what's happened with the commodity prices. So a lot of volatility, and that's probably a bit foreign to our clients because 2025, outside of Liberation Day, back about a year ago, markets were pretty sanguine throughout the year, and now you've got this pickup of volatility that it presents challenges. But I'm going to say so far, it's resilient has been the key term that I'm going with.
I think volatility, though, Craig, that's kind of the key word that I heard here. And volatility is going to come from, changing headlines. And you mentioned that, Trump said that, hey, the war's almost over. I mean, I think yesterday, within 24 hours, he said the war's almost over. It's just beginning. We're winning this fight, but we could do a lot better. I mean, there's so many mixed messages coming out there. Sunday night concern, about oil, where, as you mentioned, it shot up to $120 a barrel, down another 35 over the last 48 hours. That kind of whipsawing based on headlines and uncertainty is really what's, driving the market here. One thing I would add, though, I think that the risk is, and that's why oil is so centric, is that coming out of an inflationary environment and, being currently in an environment where inflation is still kind of top of mind, when you see oil go from $60 a barrel up to 125, even where it is now at 85. I mean, I filled up my car this morning, and I
Ouch.
think it was, 210, and I don't know, a month ago, it was probably $1.70. I mean, that's a pretty significant change for families that are struggling to, pay their expenses every month. And, we'll see that here in Canada. We'll see it in the United States, unless oil prices moderate.
What parts of the market, like what sectors have been the most impacted outside of obviously oil and other energy related sectors?
Yeah, maybe I could tackle that. I think we're seeing it directly in our portfolios where when you see, headlines that are favorable, you see money flow back into some of those mega cap technology based names. That's very, very short term over the last couple of days. So this rotation that we saw earlier this year, where money was coming out of big technology, I'm starting to see some demand pick up there. Obviously, if you're a hotel operator, airline company, a cruise ship operator, it's been a real tough 10 days for you. And I think those sectors are probably going to be under more pressure. We'll probably maybe even talk a little bit about on the podcast today, but you've certainly seen a bit of wind come out of the sails of financials. I think that's a reflection of some credit concerns that are looming within private credit. That being said, look at some of the numbers coming out of financials, in particular Canadian banks, still firing on all cylinders. That I'm using this, and I think we as a team, we're looking at this as this volatility is once again an opportunity to say, hey, the likes of JP Morgan are off 15%. Is that an attractive entry point?
The obvious question that comes up, though, and probably what are top of mind for our clients are, you have an invasion of Iran, or at least a war with Iran right now. Trump wants to say, hey, it's almost over, but I think the market or parts of the market or, certain countries may feel this is going to be a little bit longer drawn out. And so I think the obvious question is, what kind of effect does this have on the economy and market over time if this doesn't end, say, this week, but it does get drawn out like other conflicts?
Yeah, and I think it's so well said there, Clark, as we've learned over the 25 years of managing money that making investment decisions off of geopolitics is definitely probably a fool's game, I would say. It's geopolitics is not tradable. And I think, Jay, you've mentioned a chart here that you're going to show, and maybe you can speak to it about all the geopolitical events that we've uncovered over the last 25, 30 years, and you can see the impact on markets.
Yeah, and I mean, I think this just kind of jives with our kind of constant reminder of the fact that we are long-term investors, and when we are presented with periods of volatility like Liberation Day last year, like we've kind of seen in these last 10 days, that the market tends to look past these things, and to some degree, war is good for business. The old saying can actually create some economic opportunity, as grim as that sounds. But at any of these kind of previous geopolitical flare-ups, some lasted much longer than others, obviously. Rarely was it a good time to make significant adjustments to your portfolio. The good companies that you held prior to any of these conflicts remain good companies 6 months, 1 year after the fact. Staying invested through these issues was always the game plan, always the right game plan. And this time I don't expect it to be any different.
A couple of things that stand out there on the chart is, the most recent Israel attacks Iran's nuclear facilities. I think at that point there was concern that this was going to be a global, not a global, sorry, a broader regional war. And there's an initial market reaction, and then look what happened right after that as the market continued to move higher. And then it takes us to where we're at today. If you look back on a couple of things where somebody looking closely at this chart might question it, that Russia invades Ukraine and we saw a significant correction after that, but then the market took off again. That coincided with inflation kind of rearing its ugly head. That wasn't a result of Russia invading Ukraine. They did that kind of as inflation was picking up. It continued to pick up. Similar to Russia invades Georgia back in 2008, 2009, that coincided with the financial crisis. So that's the downside you're seeing on that chart. So, generally these global events really haven't had a measurable effect and haven't been a reason to change a long-term approach in a portfolio. If anything, these events have created some volatility. As you mentioned earlier, Craig, when you see certain securities down 10, 15, 20% on fear and these short-term concerns, if anything, it presents an opportunity.
Yeah, well, 2022, that was, if anything, that was probably one of the more challenging years we've had as portfolio managers. The reason being, as you said, inflation was running at 8, 9, in some cases, I think even got to 10%. And all asset prices were challenged, whether that's stocks, bonds, commodities, currencies, real estate. 2022 was a tough environment. And I think that's one thing that we're paying attention to here is what's happening economically. No one knows the outcome of what's going to happen here with Iran and US, how long that's going to be drawn out. But if you look going back to last week, we had some weak unemployment numbers out of the US at a time when you're talking about inflation potentially being more anchored. The word stagflation starting to rear its ugly head here. I don't think we're there yet, but if you start to see a continued trend of a slowing economic environment while inflationary pressures are anchored or in fact pick up because of prolonged energy prices, that I think presents more challenges for the broader market.
Yeah.
I think to that point, or this chart kind of speaks a little bit to the potential for persistent higher energy prices. So kind of a similar chart to what we just showed, but data showing basically on all of these geopolitical conflicts, the market reaction after 1 week, 3 months, 1 year, both in Canada and the US, and then also the price of oil over those same time frames, and most of these had some relation to the Middle East, where of course we do still rely a lot for global oil production. And if you kind of look, a few things we'll point out here is 1 year after the fact, 7 out of 10 times the U.S. market was actually higher. In Canada, it was 6 out of 10 times. But I think most interestingly, over here on the right-hand column, in only 3 out of 10 of the last geopolitical conflicts, were oil prices actually higher than once the conflict started. So in other words, within a year, oil prices had actually fallen, and in some cases materially so. So kind of speaks to the short-term nature that these impacts tend to have. And hopefully, to your point, Craig, we can avoid kind of that inflationary environment at a time when we've got some weakening economic data coming out.
Let's maybe dissect that, and Clark, maybe I'll ask you or Jay. The response may be, though, well, this time it's different, right? You got the Strait of Hormuz at play here. You got Iran, who's a pretty big exporter of commodities. What's our response there?
Well, I think you could look back on what are, there's a dozen different events here. Iraq invades Kuwait, Operation Desert Storm, 9/11 attacks, Russia invades, Georgia, Ukraine, etc. I bet you if I had phone calls during every one of those events, other than the early 90s because I wasn't around, but some of these events and people, clients would say, hey, but Clark, this time is different. And when we look back, they really weren't. They were short-term events that caused short-term market volatility. And then ultimately, and in some cases the next week, in some cases 6 months later, the market really regained focus on what really matters, which is the underlying strength of the economy and companies that we manage in portfolios. And I don't think this time is any different. I mean, I hear it, I heard it with Ukraine, but Clark, this time is different. This is going to be a European war. This is the start of World War III. No, it's not, right? And I think we're hearing it again. What I would say though is that I think what's maybe a little bit different this time is we do have Trump, and I think the messaging from Trump tends to be a little bit erratic. As I mentioned earlier, yesterday he said the war's over, and then 2 hours later he said, hey, we're just beginning. And when you have that lack of clarity in the message, and I'd also argue that I don't think Iran's going to go away quickly and peacefully anytime soon. So, maybe this is a bit of more of a drawn out thing than the market's appreciating. I think that's the risk. But again, I don't think this changes the long-term fundamentals of things in the global economy.
And if things do kind of spill over and become a more prolonged and escalating situation in the Middle East, what's our message to clients if that is the next 6 months that we're still dealing with this issue?
I would say that there's a tendency to always, look at what's happening with stock markets. We wake up in the morning and see the Dow Jones or the S&P or the TSX is doing this. It's up or down a certain amount of points. One thing that's often overlooked is what's happening in the bond markets, what's happening with yields. I would, and I know we do this as portfolio management team, we're on top of what's happening with yields. If you start to see, let's use the US 10-year Treasury as an example, that's currently trading at about 4.1%. If you start to see that move higher, let's say it gets back to 4.5, I don't think we're getting to 5, but if you start to see bond yields move higher, that's a sign that the bond market is telegraphing more anchored inflation. I think that has more of a lasting impact, as we said, economically. Uh, Bond yields have moved higher over the last couple of weeks. Not surprising what's happened with energy, but I would use that as one pretty significant cue that we'll look at how do we position portfolios. And I would continue to look at some of that data that's coming in on the economic front, unemployment rates, consumer confidence, small business optimism, because all of that is going to ultimately drive what the path of interest rates are. And we have a new Fed governor coming in May, replacing Jerome Powell, and he's been hell-bent on saying interest rates are going lower. If the bond market is telegraphing a different message, that's going to be a challenge for central banks. That's what I'm looking at over the next couple of months.
You're correct, and I think that's where some of the uncertainty over banks are. Is it just on some, concerns about what interest rate policy may look like, or kind of a lack of acknowledgement on, there's difference of opinions definitely with where interest rates are going. Now, the one thing I would ask you, Craig, though, is you talk about inflation, you talk about interest rate policy. Let's put that back to what's going on in Iran right now. What's one of the largest contributors to inflation?
Well, energy and food, and it's funny how they strip that out. And I think tomorrow we're going to get that CPI data. Yeah, the longer that commodity prices persists, anything north of probably $65 a barrel, that's going to be a challenge for the inflationary numbers.
So, I mean, some potential economic weakness if this persists and oil prices stay elevated.
Yep.
I'd argue that that's potentially in the cards, and I think we all have to, be aware that that is a risk. What does that risk mean, though? Jay, going back to that chart that you just had up, I think the event that of the events you mentioned there, Iraq invading Kuwait, I think 6 months later, oil prices were still 60% higher. And 3 months later, equity markets were still down. But if you look a year out, oil prices had declined relative to when Iraq invaded Kuwait, and equity markets were higher. And I think, regardless of what happens in Iran, whether it's over this week or whether it gets drawn out for the next 3 to 6 months, the market's going to react one way or the other. But ultimately, again, look back in a year, my guess is it's going to be a non-event, and markets are going to regain focus on what really matters over the long run.
And on an individual basis, I think we've got to be prepared for whatever happens, and that's just, I think, on us, and looking at clients' personal situations and understanding if you've got enough cash flow to support your needs throughout the next year, not being dependent on the market being up to satisfy whatever capital needs you have. So it's kind of having a good financial plan in place, which is obviously something that we continue to advocate for.
Sum it up, and I think, Craig, you started this segment with the comment that it's really been to some degree a nothing burger for the market. And I did text you on Sunday night because I was like, geez, oil prices are up 25-30%, like literally as we speak overnight. And Dow Jones Industrial Average futures were down 600 to 800 points. The market started off at that level yesterday, ended, I think, up 200 or 300 points today. I'm just looking at the Dow now, up another 300 points. And the market is essentially where it was, 3-6 months ago. We've been doing this in the market for the last 6 months. A lot of people aren't aware of this. The volatility that we've seen over the last week is pretty much in line with what we've seen over the last 6 months as well. So, really, to kind of sum it up, so far it's been, really nothing in the market, in my view.
Yeah, and if you're a trader and you can time things perfectly, which we're not part of that, the last 10 days has potentially been opportunistic. And I was doing some research over the last 24 hours preparing for this, and as an investor, I think the better approach to look at things is, what's happened with individual names. One name that we've picked up more recently in our portfolios is Microsoft. There's a prime example of a name, and I give you guys full credit coming into 2026. We're hesitant, well, not even that, I'd say for most of 2025, we're hesitant on the valuation of a name like Microsoft, right? Software has been an extremely challenging sector within equity markets for the last 4 months. Microsoft's gone from 32 times last fall down to 22 times. It's had a massive multiple compression, what we call it, and the stock price is reflective of that. Amazon's gone from 32 to 26, Apple to 34 to 29, Oracle, which we don't own. There's probably the software. That was one that got a lot of attention in October. That's gone from 46 times to 19 times. I don't want to get caught up in numbers, but as an investor, that's what you look for is when you see high quality companies that have had a reset in valuation, and you look at that and say, is that an entry point that's attractive that we can redeploy capital? That's how investors look at things, not based off what's happening with the hour-to-hour tweet or headline.
Yeah, just to clarify something, Craig, the numbers that you were throwing out there were price to earnings multiples. So
Yeah.
what we see as the valuation of stocks. To quantify that, put it maybe in a little simpler terms, Microsoft, which, late last year, I think November was up at about $550 per share in price. For the reasons why you mentioned, has seen a pretty significant decline in its valuation, which is translated to a decline in its share price. Hit a low, 3 weeks ago of, I think, $390 a share, around that level. To us, that significant of a decline in both the share price and valuation means it's attractive to us and it presents an opportunity.
So switching gears a little bit, Canadian economic data came out last week. The fourth quarter GDP number showed a slight contraction in the Canadian economy. This is something that we've continued to kind of come back to in terms of just taking a temperature check on how Canada's economy is doing, as that affects a lot of our markets that we're looking at. We continue to just be stuck in this slow growth, anemic kind of mode as a country economically. When are we going to start growing again? Is this kind of lift in energy prices going to be the catalyst that finally sees Canadian economic data start to impress, or what does the recent data start to tell us?
Yeah, I'm not sure if the recent lift in energy prices, I mean, we just spent 15 minutes here saying that we think it may be a non-event and oil prices moderating, albeit, they're probably going to remain at a heightened level for a period of time. Is that going to be the catalyst to significantly change the Canadian energy and resource sector that we need? I'd argue not. We need, some change with policy to make that happen. I do think, we've talked about it on previous podcasts. I think with the new government, we're starting to see that. I think that's a positive. If anything, I think maybe the heightened energy prices, I take the under, in a sense here, Jay, on this, is I think that the other side is that heightened energy prices, I just mentioned it was $2.10 a liter instead of $1.70 to fill up my tank this morning. It's not going to be a big issue for me, but I would argue for a lot of people, that's pretty significant, on top of the other headline in Canada, which is higher food costs. We have significant inflation costs when it comes to food. I mean, I'm sure you guys have been out either grocery shopping or at restaurants recently. It's unbelievable how escalated the prices are. And so I think we have some economic risks in Canada. Something I think we're going to touch on a little bit later, Jay, is on credit in Canada. The ability for developers to finance construction of new housing. I mean, how significant is construction and construction employment for the Canadian economy? It's one of the largest sectors of employment in Canada. So I think those are the things that I would say currently are headwinds in the economy. On the energy side, I think it's going to be more of a longer term approach to changing policy in Canada before it becomes a significant contributor to positive economic growth.
Yeah, I think one thing that's really interesting and a huge benefit of being a Canadian-based investor is you go through these kind of inflationary push and pulls, and even these geopolitical conflicts where energy prices go up, and obviously we're still an extremely large energy exporter, and the Canadian market now is one of the best performing markets year to date, thanks to some elevation in gold prices and then a push in energy prices. So for Canadian investors or Canadian consumers, as a participant, hopefully in the Canadian economy, offsetting some of those higher grocery prices, some of those higher prices at the pump is some participation in our commodity markets.
Do you feel wealthier, Jay, because your Suncor and Enbridge are hitting all-time highs? And you're
Well,
going out to, are you going out to
Yeah,
GOP or Giardino any more often? I'd argue not. Uh, I know the point you're trying to make is that, generally with equity markets being strong, the wealth, the fact that you feel wealthier, and I think that's the point you're trying to make, and you go out there and spend a little bit more.
Well, think about being a European-based investor, right? Where every tick higher in energy prices not only hurts you at the pump, but also look at the European markets just in the last 10 days. I mean, they basically nosedived because they're so dependent on energy imports, right? So it is, I think, a beneficial position to be in when we're not only extremely far away from a lot of these conflicts, thankfully, but also, subtle beneficiaries of higher energy prices.
Yeah, again, I'll just kind of make the argument. I don't think that us being investors in the Canadian market and the Canadian market strong is going to change my behavior as a consumer. If anything, and I'll be quite honest, I mean, going through my credit card statements for last year to do my tax return, and I saw, revisited some of my restaurant expenditures and things like that. I went to Costco for the first time last week, for the first time in a year, and bought a whole bunch of bulk groceries. I mean, that's the honest truth. And I mean, part of that was geez, oh my God, I'm spending a ton of money on food and looking to reduce my prices. And that's me. And I don't think I'm alone out there.
Well, maybe you need to downgrade from expensive French wines into something a
Oh,
little bit
geez.
cheaper, or from a fillet steak to a sirloin or something. But
Look
no,
who's
I think
look who's talking here, Mr. White.
no, but I think you're exactly right. It's those trends of shopping, and thankfully I don't participate in the majority of shopping within our home, but I notice it. I opened up a pack of steaks last night, and I was shocked at the sticker price of it. So that's real, and I think households continue to feel those pressures. Maybe pivoting here, what's happening with Canadian real estate. Look at some of the recent bankering, as I mentioned 10, 15 minutes ago. You're starting to see, certainly some cracks, if I could call it that, some weakness within the Ontario and the BC markets. This buildup in inventory that we've experienced over the last 3, 4 years has been beneficial for the rental market. Rental prices are coming down, but it's still a stagnating real estate environment. And we just talked about interest rates. Rates are still quite a bit higher than where we were 24, 36 months ago, with, 30, 40% of mortgages renewing here in 2026. Considering real estate such a huge part of the Canadian economy, I expect that continue to be sluggish throughout the next 6 to 12 months. Because I don't see interest rates dropping anytime soon. I think the Bank of Canada is pretty well anchored with where they're at currently. At best, maybe you see a 25 basis point cut, but go back to everything we've talked about. What happens with commodity prices and the lasting impact of that? So I'd say
Thankfully,
it's
thankfully we have avoided the 6.5% mortgage rates where we were a few years ago, and we're now at a more reasonable level. And a lot of those mortgages that were issued at the depths of COVID, when interest rates were effectively zero, and there was I think a blip there where people were getting 5-year more fixed rate mortgages at 0.99%. The first time ever it's been less than 1%. Those rolling over into 6.5% mortgage would be extremely painful in terms of your monthly payments. Thankfully, with inflation coming off of its highs, we're now looking at kind of sub 4% on mortgage rates, which hopefully will help us avoid worst case scenarios when it comes to the Canadian financial system. And we did see that of the Canadian banks, like you alluded to, Craig, in their earnings last week, which were largely better than expected. So the Canadian economy is continuing to kind of limp along, I would say, and hopefully we see the housing market on one hand kind of get through this environment, and also the commodity market not kind of reach that Goldilocks environment where it's strong enough to support job growth and strong kind of economic numbers on that front, but not too hot to create even more inflation for consumption.
We probably have more concern in the Canadian real estate market as it relates to inflation is, on the development side, the construction side. I think we talked earlier just about, some of the difficulties in the credit markets, and these are not, so I think it's actually relatively easy at this point for a consumer to get a mortgage at a relatively low rate. I think, Jay, you had mentioned, 5-year mortgage is now 3.5%. So I don't necessarily see that as a huge risk, but the lack of access to capital of developers right now, where they had extremely easy access to capital 2, 3, 4, 5 years ago, I think what that does is it basically slows down development of new housing in Canada. I mean, essentially, multi-family developments grinding to a halt. And, that has been a huge contributor to high cost of living in Canada. And the government's focus was to increase the housing supply to help bring those costs down. And that's not happening, particularly given the difficulty with credit amongst developers.
Yeah, what are we talking about that, Jay? What's happening within credit markets? We mentioned that a few times now, and you've seen a few things. And again, from a market perspective, heading into this Iran-US thing, that was getting most of the attention. What's happening within private credit? Why don't you kind of provide some insight there?
Yeah, so in the US, I mean, we've touched on it here in Canada a few times now, mostly related to private credit and private real estate funds that were stopping redemptions for investors or gating their funds. And we started to see that in the US developing as a story this year with some of the biggest private debt issuers or funds that were being made available to retail investors. And really what private debt is, there's public debt where you can buy bonds that are issued by publicly traded companies. And then there's private debt where companies go out and issue loans to developers, to companies that are building data centers, anything that's kind of on a smaller scale and generally has higher risk can be done kind of on the private side. And it's kind of a classic tale of financial companies that create opportunities for retail investors simply by saying, okay, you can get 4% from your publicly traded bonds. Well, hey, why don't we give you 6 or 7% from these private credit opportunities? And potentially they've got the same level of risk. Well, if you're getting a higher yield, you've always got to ask yourself, why am I getting paid more than I otherwise could be on a comparable product? And as we often see, this is something that we touched on a couple of years ago with the mortgage investment funds here in Canada, similar type story, where now you've got a liquidity mismatch between these investors that are expecting their yield payments to come in on a monthly basis. And in some cases, these development projects, these data centers, they aren't cash flowing the yield that needs to be paid out. So you've got this mismatch in cash flows. And now a lot of these funds are being gated. We've seen this in Canada. We've seen this in the US. The big question is this going to be a localized problem relative to the funds that these investors are in, or is this something that can spill over? I've seen one thing that suggests the total size of these private debt pools is over $1 trillion, which would obviously be meaningful. But it is a concern. It is something that the market's kind of paying attention to some degree. I think the biggest impact, as Clark, you mentioned just now, is what impact that has in overall credit availability. And that's one thing that kind of, I hate to draw comparisons to the financial crisis in 0809, but when credit sense is an issue and all of a sudden banks are less willing to lend, that tends to kind of slow the wheels of the economy.
I think there's two sides of it. And you mentioned the liquidity risk, right? Which is if you're getting, 6 to 7% on something, rather than 4 on a government bond, well, it's, there's higher risk debt, but you're also getting compensated for that lack of liquidity. And, what's happened over, the last number of years is an asset class that was basically designed and reserved for institutional investors. So if you're a pension plan, if you're an endowment, if you're an institution like that has extremely long-term liabilities, 40, 50, 60, 70 years out, you can invest in these investments that don't have lack of liquidity. And if those underlying asset prices go down, you're not too concerned, and you're not going back to the sponsor of those investments asking for your capital. As these investments start to be promoted to retail investors, they, in my view, and we talked about this before, promoted in the wrong way, that you get no risk and you get this above average yield that you just talked about. That's great until things start to go wrong, and you're not an institution. You don't have a 50 or 60-year cash flow liability. You need that cash tomorrow, next month to pay your bills. That's when you go back to these issuers and want your money back, whereas an institutional investor wouldn't. I think that's really what's gone wrong here. So there's a couple things that, a couple risks that come out of that is if you've got a segment of the Canadian investor base or the Canadian economy that don't have access to their capital, that's a negative to the economy from a consumer spending point of view. And second, if these institutions, the sponsors of these funds, can't attract capital, they can't keep it, they definitely can't attract it. Just like you mentioned, Jay, there's no ability to go out and issue new loans to some of these developers. And that also slows down the Canadian economy. I think it's a huge problem. And the numbers that I have seen currently in the Canadian space for private real estate and private mortgage funds, 40% of assets are currently gated. I mean, that's a significant number. And I think that problem just gets worse. And, this stuff becomes kind of a self-fulfilling prophecy. If you hold a mortgage fund or a real estate fund that currently is healthy, but you see 40% of that market gated in Canada, what would you do? Would you give them more money? Would you remain invested, or would you ask for your money back?
You get in line with everybody else saying, I want my money back. And what happens is they continue to reduce the amount of liquidity, and they may announce a quarterly, semi-annual, annual redemption privilege, and it's prorated based off of the interest of those redemptions. And when we talk about liquidity, it's so important for our clients. And we talk about gating. Gating is essentially you don't have access to your capital. If you do, it's very limited. And I'm telling you, in the years we've been doing this as a team, liquidity matters, bottom line.
Yeah, and go one step further. This, currently it's isolated to, mostly to private real estate and private mortgage funds. But as I just mentioned, if you've got a healthy private fund, so private equity, you've got some of these that hold, farmland or timber, other assets, and they're healthy, but you're seeing, private funds in the real estate space gate. Again, what are you going to do with your private equity fund? You might just say, hey, look, I'm less comfortable having my money tied up in something that really isn't liquid. I want my money back. And I think, you look in some areas of the market, like asset managers in Canada and the United States that manage some of these pools, they've seen pretty significant share price weakness recently. And I think that's probably what the market's starting to sniff out here. And I think that's a risk that I think we have to be aware of as well.
Yeah, I think, Jay, you said it best there as well. Where the need and demand for credit. Credit is the lifeblood of the economy. If credit starts to dry up, and we're not saying it is right now, but traditional banks, they've tightened up the regulations coming out of 2008, 2009. So a lot of these higher risk mortgages have gone to these non-traditional lenders. It hasn't filtered over into the banks, but share prices are starting to reflecting it somewhat. So again, something that we're continuing to pay attention to is what's happening within the credit space. If you start to see defaults pick up on the private credit and private equity, that's just another potential, I dare call it red flag, but a yellow flag that goes up.
All right. Well, hopefully we haven't sufficiently worried all of our clients into
We'll shut up now.
Bunkers, but
I think things are still good because I don't know if you noticed after Craig was criticizing me for French wine. And by the way, I don't drink French wine. I'm not that sophisticated. But you added that you actually opened up a pack of steaks last night. I mean, it was like a Monday night last night. Is that how the household eats? Like,
well, I call
I'm guessing you had a glass of wine, of some nice wine with those steaks. So I just want to touch on that before because that actually sounds like an economic positive. And I know we kind of ended this with some risks, but just want you to jump back to that a little bit.
I appreciate that. I'll have you over for a nice glass of red wine and a steak next
Because
time
you know
you're
what
in
I had for
Kelowna.
dinner last night? I actually had some of my Costco food. I think I had part of my block of cheddar, and I had some pepperoni, and I had one of those bags of broccoli, those big bags of broccoli. So I'm starting to feel a little bit, and just scaling back a ton. Glad to see that the entire team is not though.
Yeah.
Let's circle it
Well,
back. What's the key takeaways for our clients? What we probably say, expect probably near-term volatility. The outcome Iran, US remains to be seen. We're watching inflationary pressures. We're obviously paying attention to what's happening in the bond markets. Most importantly, we're staying on top of portfolios. And if changes need to occur as these, short-term data points come in, if they turn into more of trends or themes, then we'll react accordingly. But circle all the way back to what you said, Jay. How's things in the markets and portfolios? So far, things have been extremely resilient, and that I would say is a key takeaway for our clients.
It's a great message, Craig.
Yeah.
All right, well, hopefully next month we've got a stronger Canadian economy, less geopolitical conflicts, and private credit is also a story of the past, but time will tell. Thanks, guys.
Thanks, gentlemen.
I'm looking forward to that steak.